Greetings, and welcome to another installment of Viewpoints by Hennessy Funds. My name is Eliot Bishop, and I'm a Portfolio Strategist at Hennessy Funds. And today, we're going to cover the Hennessy Gas Utility Fund with the portfolio managers Ryan Kelley and Josh Wein. Ryan, for those of our viewers who are new to the Hennessy Gas Utility Fund, could you please review the investment approach and how the fund is currently positioned as a result?
Sure. So first of all, this fund is was actually started back in 1989, and it was designed to allow investors to get exposure to natural gas utilities, which were a small but growing part of the overall utility market. It's been through a couple different different managers and a couple different iterations of names, but overall, this fund has been invested the exact same way since inception of the fund. The fund actually replicates the AGA stock index, and this is a proprietary index which is created and kept by the American Gas Association in Washington, D.C. It's comprised of all publicly traded companies of the AGA, which covers about 95% of all the distribution companies in the United States. This is a market cap weighted index. However, it's then further adjusted by the percent that companies are dedicated to natural gas. So if you have two companies with the same market cap, but one has 100% exposure to natural gas and the other is only 50%, well, the first stock will be twice as big as the second in the fund. And also, just overall, there's a 5% maximum limit on any one position. Right now, where it stands is that we have about 38% are classified as energy companies, although these are really the major pipeline companies that move natural gas around the country, as well as LNG export companies. 27% are multi-utilities, both natural gas and electric. 15% are electric, and 15% are pure play natural gas.
So Josh, 2025 was a good year for the utility sector. What were some of the biggest tailwinds that helped drive performance in utility stocks?
Yeah, it was a really good year. And first and foremost, whenever rates come in a little bit, it gives a bid to utility shares, as a bond proxy. The dividends that utilities pay, which are, fairly consistent and tend to grow over time, look more attractive in a lower interest rate environment. But, this time around, what's different is just the demand side. So, electricity demand tends not to grow very much year to year, if at all. This current year, the Energy Information Administration is projecting about 1% increase, and next year about 3%. So if that's the case, that would be the best 4-year growth in electricity demand since 2020, and the biggest rate of growth, the first positive rate of growth for a 4-year period in about 7 or 8 years. So, there's a backdrop, obviously, with data center growth. I think data center demand grew at about 14 or 15% last year, give or take. That's something that is very real. We hear about it all the time, and that is definitely making a mark on the demand profile for electricity.
And Ryan, the U.S. exported record levels of liquefied natural gas in September of 2025. So what drove those record levels, and what is the fund's exposure to LNG?
Sure. Well, first of all, U.S. This has been a huge growth story for the U.S. LNG market in general, and that's the exports. And we've been the biggest exporter around the world since 2023. This has been driven by both demand in Europe as well as in Asia. In Europe, we're now 60% of all LNG imports into Europe. And in Asia, it's primarily Japan, South Korea, and India, which are driving the demand there as well. Here in the U.S., our export capacity has been booming. In fact, the EIA put out a report that said that we're projected to more than double our capacity by 2030. And that's just from projects that have already been announced or are already in process. The great news is that we think that this growth story is going to continue. We don't see a whole lot of risks to it. And the fund certainly has exposure. We have a 5% position in the fund for Cheniere Energy, ticker LNG. We also have many different major pipeline companies as well as large utilities that have exposure as well, either by delivering the feed gas to these facilities or by investing in or owning these facilities themselves. So that's companies such as TC Energy, Kinder Morgan, Sempra Energy, all 5% positions in the fund as well.
Well, then, Josh, what recent policy or regulatory developments are most likely to influence the demand for natural gas in the coming years?
Yeah, so the demand for natural gas, I think the old phrase "supply creates its own demand" is very important here. And so first and foremost, the current administration has been very dovish on trying to get these facilities, started. Changing the permitting environment and the regulatory environment. The Federal Energy Regulatory Commission has already taken steps to make it easier to conceive and build these projects, whether it's a pipeline or an exportation facility or just a good old-fashioned natural gas-fired power plant. The Energy Permitting Reform Act of 2024 would go further in terms of making the permitting process a lot easier. I mean, I think for anything infrastructure related in the United States, permitting is a long process. Complicated, takes a lot of time, and that is the biggest impediment to getting a lot of these things off the ground.
And then, Ryan, all of the 2026 market outlooks that I've read from CIOs at some of the largest wirehouses and broker-dealers are all encouraging their advisors to find other ways to invest in the explosive growth of AI. So how is this particular fund a good fit for that mandate?
I would agree with that sentiment. I think it does make sense for investors to diversify away from the major spenders right now and look for the beneficiaries of all that spending. These hyperscalers, they need more data. They need more power. They need more power for these data centers. And that's all very beneficial for utilities, for power producers, as this continues along. We need a larger grid. We need a more resilient grid. This is going to be very beneficial for the electric utilities as they build that out. So overall, for the fund, we have exposure to all of that potential growth. Overall, we think that there are some risks to this AI boom, and not necessarily whether or not it's going to all pan out, but how fast are they actually going to invest and for how long? But right now, the race is in full swing. And these hyperscalers are looking for affordable, reliable, and efficient power, and natural gas certainly fits the bill.
Josh, here's a question we get from advisors quite frequently. So, are the returns of the Hennessy Gas Utility Fund directly tied to the price of natural gas?
Yeah, it's a logical question. I mean, the returns are not tied to the price of natural gas. We recently saw some pronounced spikes in the commodity, and it certainly makes people wonder. But no, the regulatory environment is such that the price of natural gas gets passed on to customers. So the end user bears the brunt of either high or the benefit of low prices. As a utility, all they care about is their residential and industrial customers and their use of electricity and natural gas. So it's a volume business, and really over time, the price of natural gas is not at all a determinant of the returns of these companies.
And then Ryan, we'll wrap up with you. So for advisors that are interested in adding exposure to utilities in their clients' portfolios, how is the Hennessy Gas Utility Fund a little bit different from other utility funds in the market?
I like to describe this fund as primarily a utility fund, but with a much more heavy weight towards natural gas and with an energy kicker. Because of the way that the index and the fund is constructed, you get a lot more heavy weight into the natural gas utilities versus many other funds out there. And then because the fund includes all distribution companies, and these are major pipelines and LNG exporters, they are classified as energy. They also move oil around the country as well. And so there can be an exposure to what's happening in the energy markets. Overall, that extra exposure has been a net positive for the fund since inception, and certainly over longer time periods, although it can add some volatility. Primarily, again, this is a utility fund, and as Josh mentioned, a defensive posture in more volatile environments.
All right. Well, gentlemen, as always, thank you for joining me for another Viewpoints by Hennessy Funds. For those of you interested in learning more about the Hennessy Gas Utility Fund or any of the other products offered at Hennessy Funds, please join us on the web at hennessyfunds.com.